Hi, and welcome to another episode of Nursing Your Way to Wealth, where a mental health nurse and an accountant talk about wealth creation, personal development, and financial independence in the UK to help you live the life you deserve.
Hello, and welcome back to another episode of Nursing Your Way to Wealth. I'm here with Alex, and today this is episode 8, and we're going to cover just briefly the basics of investing because we've both heard a lot of misunderstanding, perhaps some misguided thoughts about it, and quite a lot of confusion. When actually, if you get your head around it, it can be a really powerful wealth building tool along your journey. So, Alex, if you could just give us a real basic overview. If someone doesn't know what investing is, never heard of it, perhaps a bit afraid of the term, how would you define it?
Yeah, hi Alex and hi everybody. It's a really good question, and I think investing can sometimes conjure up those images that you'd see on the news where there's seas of red everywhere on all these screens, and you've got traders with heads in their hands, and it's volatile and risky and scary. But ultimately, investing, what you're doing, and when it's done right, is you are purchasing a tiny share of a business. So let's say you wear Nike trainers and you can go onto the stock market and purchase, instead of buying a pair of the newest Air Force Ones or whatever, you can actually go and buy a really small percentage of that of Nike. So what that does is allow you as an owner of that business. So you become an owner, a partial owner of Nike, and every year you'll get two things hopefully with from your shares. One, you will be given a dividend as an owner of that business. You get a share of the profits, and over the long term, you would expect your business to grow, and you would therefore expect the value of Nike would grow, and the value of your share would grow in that business. At its very basic level, the stock market is just a way of matching buyers and sellers of ownership of a business, and it's over the long term one of the best wealth building tools that is available to us. And through the invention of some of the funds that we'll be talking about, and through technology, it's becoming much more accessible to kind of the everyman on the street. So it's certainly not the exclusive club that it may have been 60, 70 years ago. So yeah, hopefully that makes hopefully that makes sense.
I think it does. Obviously, I understand it, perhaps not quite as well as you, but the way the way it was described to me 6 years ago, like you say, you can buy. We all consume things, products, services all day, every day. So, for example, you get in your car, you drive to work. Your car is made by a manufacturer, and their company will be listed on the stock exchange. And you have that ability. You're happy to buy a car, spend thousands of pounds of your salary on a car, yet some people are reluctant to own a small piece of that company. And it really gives you the ability to earn more money alongside your salary, so your money can work for you as well. One person described this to me, Andy Hart, who runs Maven Money. He described it as the people who own and run businesses are some of the most business savvy, smartest people on the planet. Why wouldn't you give them a little bit of your money to grow over time? So the way you make a return on that is either you can get paid a dividend, as Alex said, or if you buy, say, 1 unit of whatever car brand, um, then over time, say you buy it for £100, you buy a fractional share for £100, and over time, that's worth more money. So if you buy it 10 years ago and it's worth £100 at that point, in 10 years' time, it might be worth £500, £200, £1,000. The, the bit that I often find people misunderstand is they see these horror stories on the news of stocks going to zero, companies going bust, people getting laid off, and you say stockbrokers in shiny suits with their heads in their hands. But that's the downside. Yes, it's possible. It's not likely if you're buying something like an index fund. If you buy one stock and all your money is in one stock, And I see people make this mistake by investing in their own company they work for, because they work there, right? It can't go to zero. But if that does happen, its downside is down to zero, and that's it. But the upside is unlimited. A stock can grow not just 100%, but 200, 500, 1,000, many multiples of that. There was one, I think, like Monster Energy has been one of the most profitable stocks over time if you buy in really early, and it's gone up something like, I think it's off the top of my head 28,000% over the last time it's been around. So it's just a way really of making your money work harder for you, instead of it sitting in a bank account earning not very much, not keeping up with inflation. You can make it work harder for you, and I've done that. I've originally took the step, probably was it 2019 December is when I first started investing money, and it's done well. There's been ups and downs through COVID, but when you understand that that's to be expected, it makes sense. And I've made more money that way that I haven't had to actively earn. All I've done to that portfolio is set it up once, paying a direct debit every month, and look out the window.
Yeah, some really interesting points there, and I think just going back to the purpose of the stock market is, so companies, when they want to grow, they need money to grow, and they can either use cash that they generate themselves through their operations, they can borrow money from banks, and they can issue shares. And essentially what you're doing as owning that share is allowing and giving your money to help the company itself grow. So I think that's all really important to remember, is that what you're investing in is not just a number that you see on a ticker tape. It's ultimately a business with people in it, you know, led and run by incredibly smart people with great resources, with the purpose of growing the value of that company. And so, yeah, that's one thing which is often misconstrued with investing. And I think you raise another good point about it's not putting all your eggs in one basket, so diversifying. As you start to understand more and more about investing, you realize how it's incredibly hard to pick individual companies, and the best thing you can do to get unless you are going to dedicate hours and hours of time to find and research, and you understand how to interpret financial statements and evaluate the kind of the future of a company, and ultimately value a share. Investing in individual companies is not advisable. It's, you mentioned, Alex, the term index fund, and these are really powerful tools, and these are funds which essentially track the entire stock market. So you can buy a fund which tracks every stock market in the world, so like a global index fund. So you are essentially betting on capitalism. Or you can buy a fund which just tracks individual markets, so they could be the US market or just the UK or somewhere in Europe. And these funds, because all they do is replicate the performance of a entire stock market, one, you've got excellent diversification across size of companies, so from the Apples and Amazons down to some smaller, lesser well-known companies, and also in different industries. So some things in the housing market, some in consumables, some in technology. So you'll be investing, and your money will be working across all of those industries, and you will be having, through the use of these vehicles called an index fund, excellent exposure to, yeah, worldwide capitalism. And this is where, and I love that the term that you just used around setting up your investments. You set it up once, as long as your direct debit goes in, you look out the window, and you just let it grow, and you keep investing, and you're consistent, whether the market's high, whether the market's low, whether the market's in the middle, you're investing. And that's the important thing, rather than trying to time and dip in and out because you see the volatility. And as you quite rightly said, but volatility is the price you pay for investing. Ultimately, the stock markets are, there's hundreds of thousands or millions of participants who are very, they're humans and very, psychological beings who behave in crowds and who, make rash decisions sometimes and have crazy euphoria and manic lows. So volatility is part of essentially the price of investing, and you just have to ignore it, and you just have to keep consistently investing no matter what you're doing in broad-based index funds.
Right. So there are a few things you said. Firstly, you mentioned ticker tape, and for anyone who doesn't know what ticker tape is all companies on the stock market have ticker tapes or ticker symbols, and it just makes it a little bit easier to track. Usually, they're 4 letters each. For example, the Apple ticker tape is just AAPL. There are obviously others, and if you are into picking individual stocks, you'll kind of get to know those. It's not something that certainly I would advocate. I can't speak for Alex, but I think he would be the same as me. I very much like the approach of you set something, you fully understand something, you set it up once, and you realize it can go up and down. And when we say volatility, we mean stock prices go up, stock prices go down. We can't control that. It's a fact of life of the stock market, and I've heard people mention that volatility is the price you pay for long-term gains in the stock market. So really, the best time to invest is when the stock market is down, because each unit costs less. I, through absolute fluke and no planning of my own, started investing December 2019, right before the COVID pandemic happened and everything went down 35%. So I immediately lost 30% of my portfolio, and we'll cover stock allocation, equities or stocks, bonds, etc. A little bit later or in another episode. And I immediately lost the kind of 30%, and I was looking at it as like, oh, should I be doing this? Is it right? What's happening? And I briefly thought about removing some of that money. So I didn't have much in it. I had, I think at that point I had something like £1,000, and I was looking at the screen. It's down 30%, something like that, and it showed like 680 something pounds in it. And I was like, I got this huge bit of fear, and I was like, oh, what should I do with it? Spoke to a friend of mine who knows a bit more about it, and he said something that I really didn't expect. He said, if you have any other spare money, now's the time to buy, because the units cost less, and over time they'll grow in value. I was quite brave, and I did that, and it really paid off. So the time to buy things is when they're cheap. So if you go in, for example, you go in a supermarket and things are on sale, you're more likely to buy more of it because it's 50% off, for example, or 30% off, or whatever, rather than if you go in and it's 50% more expensive, you're less likely to buy it. In the stock market, it works very differently. Humans tend to work and act in crowds. There's safety in numbers there. So when things are going up, things are improving, people are more willing to put their money in because they can see all the charts pointing up and to the right. The time actually to buy, you have to be brave, and when things are going down, on the belief in capitalism that it will recover. Like we got through COVID, we've got through world wars, etc. When the stock markets, and the Great Depression is another example, when stock markets have been really low. If you were alive and had a spare pot of cash after the Second World War and you bought at that point, you'd probably never need to work again with the upside of it. And the final note from me on this segment for using an index fund, I'm not smart enough to pick individual funds. I'm not good at valuing stocks, reading statements. Someone like Warren Buffett, Charlie Munger, they are very good at that kind of thing, and they've proved it to themselves by being multi or deca-billionaires. Their annual letters to their shareholders are very much worth a listen as well, or a read if you prefer that. And the reason I choose an index fund is finding a company that's going to 10x in value is like trying to find a needle in a haystack. And instead of trying to find the needle, I prefer just to buy the whole haystack. That way, I know the winners are in there, I know the losers are in there. And the best thing about an index fund is it's a or use a term coined by J.L. Collins, the author of The Simple Path to Wealth. They're self-cleansing. New companies will replace old companies. I don't have to do any rebalancing or anything like that. I just put money in every month by direct debit, and I look out the window and I enjoy my life.
Yeah, I'm very similar in my approach as well with the index funds. They certainly make up the vast majority of my portfolio. And I think one thing I would also just touch upon is I guess the question around when is the right time to start investing. So I think for me, there's two ways you can look at this. Is if you're employed or if you have a workplace pension in which your employer will do matching contributions. In your pension, your pension provider will be investing, and there will be. You should have a look at your pension plan because that will ultimately be in the stock market in some way, shape, or form. So it's a really good idea to get your employer matching up to your. So they'll often do a match, say you contribute 4%, your employer will do the same, and they usually will have slightly better, or you could contribute a bit more and they will contribute even further. So make sure that you maximize that benefit because it is completely free money, and that's a really great way to invest. On the other hand, you can also then start investing into different other accounts. So, for example, a stocks and shares ISA. But I'd always, and I do this personally, is before I started to do any investing outside of my pension, made sure that I had my built up an emergency fund, so had some buffer because which sits completely outside of the stock market, is in a nice and safe cash account. And the reason for that is if you were to invest all of your spare money into the stock market, it is very volatile, especially in the short term. And if you were to come across, having your boiler needs fixing or your car breaks down, you can actually be forced to be selling shares when you should, when it is not ideal. So you could be at the bottom of the market where you should actually be buying more, but you're then being forced into selling your shares because you've then got to meet an emergency. So I would always err on the side of having an emergency fund before then going and starting to invest, just to avoid the kind of need to be a forced seller in order to meet an emergency. I don't know what your thoughts are on that, Alex.
I think it's a really good idea and a little bit of a shield against, like you say, the last thing you want to happen is for you to be like sort your budgets out, pay down any debts or anything like that. So we'd always say as well, pay down any high interest credit card debt before you think about investing as well. Having a little pot of money is a shield against life and the unpredictability of it, because unpredictable things happen all of the time. So once you have that aside, I'd always have that. It's a bit like a moat because it adds as a bit of defense to you and your family or your fort or house against the unexpected things. So the last thing you want to do is have all your money invested, and then, for example, you need £1,000, say, in an absolute emergency that you can't, and you can't avoid it. If the market is down at that point, and you're having to sell more units of the index fund that you've bought, it's going to have a greater wealth destroying impact on you over long term. So if you can pay those unexpected costs out of a different pot of money, it leaves your money in the stock market to compound and just do nothing with it. I think Charlie Munger put it really well in one of the talks he gave across YouTube. I don't remember the exact one. And he said the best thing you can do with money is leave it in the stock market for as long as possible and leave it well alone, leave it uninterrupted. I've heard other people say that the best stock market investors are dead because they can't meddle with their portfolio. They don't react to news cycles or world events. They just leave it well alone. and you'll outperform most people, and you can amass considerable wealth through doing this. Obviously, the earlier you start, the better. So for any of you that are in your 20s, 30s, 40s, you're not too late. Even your 50s, start, do your research, learn it, and start not working as hard as you're doing for the money that you have. I've always had an emergency fund. It's got me out of a fair amount of pickles without any. I'm not worried about it. I don't sweat about it. I just say, okay, it's happened. It's annoying, but I don't have to sell any of my portfolios, and I just leave that to grow. And with individual stock buying and things as well. I meant to mention this before, but with buying and selling individual stocks, the people you see doing that, the traders on Instagram or YouTube or whatever, they make it look very, very easy. There is no way of knowing stock market movements or company movements. Companies fold all the time and new companies form, and you don't know what companies are going to go up or down. And you have to be right twice, when to buy in and when to sell. With using an index fund, which is a passive option, so you do very little active work, doesn't require a lot of your brain power or time, you have to be right once in the beginning to understand it and to set it up. There's very, very few other decisions you need to make, apart from perhaps some rebalancing in the future that we'll cover deeper in another kind of episode about it. Alex, do you have any other thoughts on broad investing, but really it opens your money up to exposure to the world, and you get all of these really intelligent people working round the clock to make you wealthier. It sounds simple when we put it that way, and hopefully we've done a good job of explaining those concepts. But do you think there's anything else people need to know?
Yeah, I think there's one thing just on the on dividends. So dividends are essentially your share of the profits of a company, and you will see will look almost a bit like an interest rate. You'll hear the term dividend yield, and this is the dividend that the company is paying divided by the price. And with index funds, you still get dividends, and you will see when um, you'll be given the option to automatically reinvest those dividends, or you can take the dividends as cash. And in theory, you could go and take that money and go and spend it on whatever you want. I would just say it's really, really important, and especially over the long term, the power of earning these dividends and then reinvesting those. So you're buying more of the same fund with money that you've been given from your dividends is a huge contributor to your wealth, and is the returns. It is one of the biggest components of the return that you will have over kind of a multi-decade kind of time horizon. So I would get into the discipline of reinvesting those dividends, and almost anything in your portfolio you should almost look at as a one-way valve. So you put money in, but don't take it out um, before you need to access it. And I think there's probably another episode that we could have on the tactics of how you go about when once you've built up your portfolio, when you start to then draw the money down. But certainly as you're building up your fund and building up your portfolio, you need to see it as almost not your money, and it's gone in and it's working for you in the background. And that stat around yes, some of the best investors are the dead ones is really true. It's when you read in the news, or whether it's on the TV or on social media, the job of those news channels is to get eyeballs and to get clicks, because that ultimately leads to them generating ad revenue. So the long-term boring view of investing, of just be consistent and put your money in, doesn't attract eyeballs, and it certainly doesn't attract ad revenue. What does attract the viewers and the clicks is sensationalist headlines. This person's either 10x their money in a week, or somebody's lost their life savings, or the stock markets are they're down and never coming back. That's the stuff that you'll see on CNBC, on the other kind of news channels. So it's being able to ignore all of that and see it for what it is, and just focus on being consistent, be disciplined, reinvest your dividends, try and put as much money as you can into your portfolio, and leave it well alone, is the best recipe for long-term success.
I think you mentioned a really pertinent point just about news cycles. And if you could see them for what they are, they're gathering attention from people and eyeballs to sell adverts. So they'll use, like, there's no such thing as a happy news source that's broadcast widely. I wish there was. It's all negative, because that again speaks to that little part of our brain called our amygdala, which is an almond shaped thing in the center of your head, which is responsible for fight, flight, fear response, freeze responses. That's the bit that's always working in the background to keep you safe and alive, and you'll start producing cortisol or stress from your adrenal glands when you witness stuff like that. So you're automatically alert and paying attention. That is the crux of it. Happy news doesn't sell. People don't pick up newspapers that have got happy stories on. They pick up negative ones because we're naturally ingrained to be drawn to those kind of things. And I can't tell you the last time I've watched any news ever. I mean, I get most of my news from Reddit, to be honest. If it makes it to the front page, I might look at it, but not. I haven't sat down and watched a news bulletin for at least a decade now. And I'm much happier because of it. I don't worry about ups and downs of the stock market. I went through a phase early on in my investing career, I'll call it, because it's something I do alongside work. I used to check it every week. And when COVID happened, I thought about it, spoke to my friend, added some more money at the time because it was cheaper. And I tried to use it to my advantage. So I watched it go down over a couple of days, and I checked it quite frequently to see the amounts go down, to see how I felt about it, to be able to deal with that and know that I can deal with it when the amounts are small, means I can also deal with it in theory, hopefully, when the amounts are much larger. And it's really something you need a good awareness of. If you're a panicky type person, constantly checking your stock portfolio won't go well. Eventually, you'll make a rush decision and you'll sell based on external forces. So I'm also a big proponent of making a handwritten plan for why you're investing, how long you're going to invest for, and when you're going to sell and when you're going to take the money out. So really briefly, my plan is to invest money so I can have choice and options in the future. So if I want to retire from work 10 years early, I can. If I want to have a pot of money so I can give my kids some towards buying a house or a car or studying uni, whatever, I can do that as well. And that's really the crux of why I do it, because I don't like feeling closed in with things. I always like having choice and options, and I suppose a bit of control over certain aspects of life. Luckily, I mean, we're both 30, they're mid-30s, I'm 35. I've got a lot of time. I've got 30 years also left to invest. When time is on your side, it's the most powerful thing for you. You can make much more money if you start investing at 20 as opposed to investing at 50, and you're going to need the money when you're 65 thinking of retiring. So that's why I do it. The thing about not selling it is because I've told myself I've written it down, I will only sell not due to market events, but when I am good and ready and it meets my financial plan. And I actually wrote the date, I wrote the time, and I signed it myself and wrote my name in capital letters. And it's in the back of my notebook that I use for these podcast episodes. And I look at it from time to time and it still holds up. My plan hasn't changed. Something really, really drastic would have to change. And now I don't check my portfolio very often at all. I probably look at it once every 3 months, something like that. just to make sure that any changes I make, any nudging up I do of my investments is going in the right place. And I've recently swapped a pension over, so I've been checking that a bit more frequently. And I'm going to take it. I'm going to take it out when I'm 60, or late kind of 50s, something like that. And until then, I don't view it as my money, although I know it is mine, but it's for future me, not current me. So I've never had the thought of taking it out early because I've solidified that in my mind that actually it's not for me now, it's for me and my family in 30 years' time. So I think it's an important thing to do to have that decided and cemented. Otherwise, human nature, you will get twitchy. You will think you might want to pull some of the money out. And ultimately, humans are the biggest creators or destroyers of wealth.
That's some really interesting things there, and I like the idea of almost the contract with yourself. And I think one way to always deal with the volatility, which is inherent with investing, is to to know the why. So, like, why am I doing it? And my reasonings are very similar to yours, and it does help to always look back to that and not get. It does help then to kind of avoid some of those thoughts, which may be similar to you, Alex. I had the portfolio get a bit of a hammering during COVID as well, and it's never pleasant to see that go down that much. But you know in your mind why you're doing what you're doing, and I don't need the money now. I need the money in 15, 20 years. So making decisions, making silly decisions now almost have can also have a very negative effect. The way that leaving money in to invest and grow is a very good thing over the long term. Taking it out in a panic and just putting it in cash isn't the best thing to be doing. So yeah, I really like that idea, and yeah, having that plan and signed, and it gives you that almost you're accountable to yourself.
Yeah, it does give accountability, and I also obviously I ran it by my wife at the same time, of why we did that. I think it's just as a final note here, which is a real brief basic of investing. We'll cover some other topics a bit deeper later on. When we say invest for the long run, we mean minimum 5 years, absolute minimum. For me, really, we're talking decades. So the money you put in, and we'd argue that index funds are a good place to put it. We would argue that, yeah, 10 years plus at least. I mean, I'm going to be investing for what I started at, what, 31, and I'm going to take it out at 65. So that's a lot of years. I think it's what, 34 years worth of investing. And Alex, correct me if my maths is off, but I'm just going to leave it there all that time and leave it to grow in my favor. And if you think about how much you can make is astounding. A good way of looking at this is Googling any compound interest calculator and just put in some figures. Start with £100 and over 30 years, and pick an interest rate of, I don't know, 8%, for example, because that's what global stock market index funds have returned consistently in the past. And put in that you can also add £100 every month, and then take a guess before you push calculate or go. Take a guess at how much you think it will be, and I guarantee you'll be way off. It'll be much higher than you think it will be. So if you're unsure, have a play with it, see the potential of what it can do for you. And the beauty of that is compound interest, plain and simple. And it's something that can work, as we've said before, for you or against you. So Alex, any last thoughts on the basics of investing?
No, I think we've covered a decent amount there, and yeah, another good idea just on playing around with the compound interest calculators. It really is yeah, unbelievable, the power of compounding. But yeah, I think we've got some really good stuff to cover as well in future episodes, and I think hopefully that's given whetted people's appetites for investing and to learn more.
Yeah, I hope so. I mean, while you've just been talking, I've just logged into a compound interest calculator and I've done that calculation. So if you were to put in £100 at 8%, leave it 30 years, and you'd put in £100 every month as well, whether the market is up, whether it's down. So total over 30 years, you will put in £36,000 of your own hard-earned money, and after that 30 years, you will end up with £150,000 and a little bit of change. And the difference between that is the amount of interest you've earned through compounding in the stock market is 114 grand, because you've only put 36 in over time and you've left it well alone. So you can make something like that. Now think about timesing that by, and if you can do £200 per month, £400 per month, how wealthy you can get without having to put the effort of you going to work in. Just by making some small sacrifices here and there, you can have a Herculean impact on your own wealth. And not even your own wealth, but you have the opportunity here to change your family tree in terms of generational wealth. It can start with you simply doing that and certainly teaching your children these lessons. And that's something, Alex, I'd like to cover in another episode about generational wealth and how to pass these lessons and learning down to your children and beyond.
Yeah, some crazy numbers, and yeah, I think that's another great episode of financial education, because that's the key for me is making sure that if you learn almost the 10 fundamental rules of finance, you're then going to your trajectory will be completely different for yourself, and also for your children and for their children. And investing and starting early, letting it grow, leaving your money to grow and compound is a great start to do that. So yeah, I think that'd be a great episode to cover.
Super. And we'll also, I think now you've said it, we'll have to cover 10 fundamentals of finance. I think that would be a useful thing for us to come up with together as a combination. So I think that's it from me. I don't want to give too much jargon or anything like that, but if you have any questions or there's some unanswered loops that we've mentioned in here in passing, do drop us an email at nursingyourwaytowealth@gmail.com. It'll come directly to both of us, and we'll write the response ourselves. No one else is doing it on our behalf yet. And I think it's just really a good solid plan in the beginning, and a good understanding can really, really help. I mean, Alex and I didn't get the financial education that we know now. We've had to self-learn all of this, and this is part of our effort and desire to bring that to you in a way that means you don't have to read the amount of books combined that we've read to learn this. You can learn from us, and then you can teach others as well. So I think that's it from us. Until next time.
None of what we discuss on the show is to be considered financial or health advice, and we recommend you always do your own research or consult an independent financial advisor or a doctor when making your financial or health decisions.